Hello, everyone. Thanks for joining us today. Today, our topic is 1031 exchange.
Are you recording on cloud or on your
Yeah,
local?
put on cloud.
Yeah, thank you.
So 1031 exchange, what it is, what are the benefits, when you should do it, and what are the rules that you need to follow. 1031 exchange is a swap of one real property used for business or investment for another one. The term comes from the Internal Revenue Code, uh, IRC, Section 1031. An exchange can only be made with like-kind properties. So like-kind properties. Like-kind properties are like in kind as long as they're the same in nature or character, even if they're a different grade or quality. Generally speaking, for the IRC Section 1031, all real properties are like-kind. So any land or building, 99% of the time will be considered like-kind. So if exchanging any land or building, then that would be considered a like-kind property and will qualify for a 1031 exchange. The exchange's intent must be to hold the replacement property as an investment or productive for business. It does not have to be the same exact type of property. So, for example, you can have an apartment building and you can exchange that for another apartment building, or you can exchange a vacant lot, can be in exchange for an apartment building. So what are some of the benefits? You can defer capital gains, defer depreciation recapture. So by doing that, you have more money to reinvest in your new property, and there's no limit to the amount of times that you can do it. Some negative parts of doing it are there are strict IRS rules and regulations. So losses are also deferred, and the tax obligation gets put down the road, but it is something that's still going to be there. One of the biggest advantages is use it as an estate planning tool. So investors complete tax deferred exchanges to delay the recognition of the capital gain tax on their disposition or when they sell their investment properties. So one common theme is for estate planning, you defer, then you pass away. So upon your death of the taxpayer, whoever you leave it to, your heirs would receive a step up in basis on the date of your death, and the capital gains can be avoided. So, for example, if you continue to do the 1031 exchanges and you keep deferring the gains. When if you leave it to your children, they won't have to pay any of those gains. Just the new basis in the property will uh will be the value of the property at the date of your death. So they can avoid paying any taxes on the gains. So we'll speak about that a little bit further a little bit later on, but that's one big tool used for estate planning. So there's certain rules that have to be followed when doing a 1031 exchange. The replacement property should be of equal or greater value than the one being sold. Uh, Replacement property must be identified within 45 days, and you must have complete the transaction of purchasing the replacement property within 180 days. So those all need to be followed for your second property to be considered a 1031 and to avoid paying taxes on it. Some more rules that have to be followed. Unfortunately, you can't use your personal residence when doing this. Does not apply for people that are in the business of flipping houses. And the proceeds from the sale must be used to purchase the other asset within 180 days of sale of the first asset. Um, and like we said previously, you must identify the asset that you're purchasing in the like-kind exchange within 45 days of the sale. So the most common type of 1031 exchange is called the forward exchange. So the forward exchange is the tax-deferred exchange in which the taxpayer. So first, pretty much you're going to sell the property you have before purchasing the second property. It's the most common one. So a taxpayer sells their property to a separate entity, and all the proceeds are given to a qualified intermediary who uses the proceeds to purchase the, the property from entity C, which is the replacement property, and all this must occur within 180 days. So another type is not as common, but can also be done is the reverse exchange. Uh, so the reverse IRC section 1031 is a tax deferral in which the taxpayer, which is to purchase the replacement property first before selling the property that they currently own. Uh, this in this example, this in this case, the qualified intermediary purchases the replacement with borrowed funds for which he or she signs a note. Then the property is then turned over to the exchange after the relinquished property is sold, and all the proceeds from the sale. So this part that's still the same is all the proceeds from the sale will still go to the intermediary who will then pay off the note. And even if you do it this way, this also must occur within 180 days. So talk about the qualified intermediary. So the Treasury Regulation 1031K. So since 1991, you have to have a qualified intermediary to qualify for your exchange to qualify the 1031. Uh, so pretty much they're the person that's going to hold on to the money, and there's some documents they have to fill out to make sure that qualifies as a 1031. Just to keep everyone honest, there's not so you can't use someone a party that you can use someone you already know or have a vested interest with to make sure that everything goes goes as is and it's smooth. So one way you can find a qualified intermediary, there's a Federation of Exchange Accommodations. They can have a list. They have a list of IRS approved intermediaries. Also, you can go to your bank, local escrow agent, or a real estate attorney uh, to help you out with that. So the documentation that has to be completed to qualify is an exchange agreement, which is a written agreement between the taxpayer and the qualified intermediary that defines the exchange and includes the taxpayer's intention, the qualified intermediary's role in acquiring the properties, and the qualified intermediary's role in handling the funds. The next documentation is a replacement property identification. So it's a form that is used to identify the replacement property. The assignment, acceptance, and notice of replacement property contract is a contract to assign contract used to assign into the purchase agreement. Okay, other documents that are necessary, such as a fully executed notice of assignment, certificate of citizenship, fully executed 593 C, receipts of you have receipts of funds, wire transfer confirmations, and an addendum to escrow instructions. The qualified intermediary must prepare these documents before the sale of the relinquished property, without these documents being filled out prior to the sale will likely be taxable, even if the funds are directly invested into a new property. All right. So it is a little bit of a complicated process, but here we have an example. So we have some. So I'm going to go through this. So, for example, if you have a property that you originally purchased for 500,000, when you make improvements to the property, that increases your what's called your basis in the property. So that increase. So in this example, we have improvements of about 50,000, which will then bring our basis to 550,000. And if we take depreciation of 100,000, our adjusted cost basis is now 450,000. And if we sell the property for 1,100,000, we subtract our closing costs of 100,000, so we'll get a net sales price of 1 million. So we would have to pay a gain, which is our taxable, which is our sales price minus our basis. So that would be about a $550,000 gain. So our taxes on that would be approximately for the depreciation recapture, we have about $25,000 to pay back. So we'll have a long-term capital gain of 20% plus 3.8% of additional taxes on the 550. And we have a state estimated taxes about 500, and our state taxes are about 11%. So we would have a total of about $191,400 of taxes. So if we're using this example, our next property must be at least 1 million, and we're able to defer $191,400 of taxes and have that rolled forward. So you can see that it's a huge tax savings doing this. It's if you have a good qualified intermediary that can help out with the process to make it a little more simple. But overall, you can see here that there is a big tax savings that will be deferred, but you can then use that towards your next property. And there's no limit to how many times you can do it. So you can start off small. On this example, I started for about 500,000, but you can start off smaller and then keep working your way up to bigger properties once, especially in the market where properties are continuing to increase in price. So if you have a mindset of looking forward, for a few years forward, you can definitely do this a few times and start with 100,000 and keep working your way up. So that's the big positive of doing this process. So that is my presentation for 1031. Does anyone have any questions?
So what if I lived in the property as a primary residence for, say, 3 years in the past, and then, I'd use it as a rental?
You have to have at least 2 years of rental, and then you have to use it for 2 years. Your next property has to be used for at least 2 years of a rental. So that'll be part of the agreement. So yeah, it has to be 2 years prior rental, and then once you get a new property, you have to use it for rental for at least 2 years.
Okay. And then what if I lived in one room and rented out another room in the last 2 years.
Oh yeah, I'm not 100% on that specific situation. I have to check.
Okay. I wonder if I can do partial 1031. Okay, thank you.